The Silicon Valley Bank has collapsed. If you want to know more about why this happened, what were some of the fundamental reasons why such a prominent bank collapsed, and more importantly, if you want to learn some lessons from the collapse of such a prominent bank, then you are at the right place. In my previous video, I had covered in very simplistic terms everything that you may have wanted to know about the collapse of the Silicon Valley Bank. I tried to make the explanation so simple that even a 5-year-old or even somebody who has no background of finance, economics, banking, startups, etc., would be able to understand what really happened. And I took this approach because of two fundamental reasons. Firstly, because of the all pervasive nature of this incident. It impacts everybody, not just people in the startup ecosystem, not just people in the banking sector, not just people in the United States. Pretty much everybody is impacted because of the way things have turned out to be. The second driving principle behind the video was to focus exclusively and solely on facts that are corroborated by data, statistics, and have been published in reliable sources. It is particularly important in this era of fake news, misinformation, and influencers who sometimes think they don't even need to know the subject. All they need to do is have good on screen presence and they can have a large following. But this is serious business. So if you're not yet clear about what happened in the Silicon Valley Bank saga, then I strongly recommend that you watch this previous video before commencing any further on this particular video. You can always come back to this. The link to the earlier video will be displayed as a card here and will also be given in the comments and the description of this video down below. Now that you would have seen that video and would even otherwise know that this Silicon Valley Bank collapse is a developing story, as I mentioned in the previous video also. And the developments have been happening very quickly, as I also hinted in the previous episode, where I mentioned that the regulators are going to have a very busy weekend. And what a busy weekend it has been. The Federal Reserve has come out with a new plan and a new term, which is a 4 letter acronym. It's called BTFP. That's quite a tongue twister, isn't it? It stands for Bank Term Funding Program, right? So, what does that mean? And why have they come out with it? If you know what exactly happened that led to the collapse of Silicon Valley Bank, then I think you will be able to guess from this term itself what it stands for. So essentially, it's a funding program to fund banks for a particular term. And as you can imagine, this has been done by the Federal Reserve to ensure that there is confidence in the world at large on the banking system and the financial systems of the United States. So that is the term that has been introduced by the Fed, which is BTFP. But let's continue from where we left off in the previous video. As I mentioned to you, we will now focus on the learnings and insights that we can draw from this saga of the collapse of the Silicon Valley Bank. And since Fed has come up with this term called Bank Term Funding Program, I will also come up with three principal terms, not just one. And these terms are not just terms, but they are principles. So what are these principal terms which are principles? Confused? You ought to be. This is what happens when we speak in jargons and we speak in language that confuses everybody. So just as we did in the previous video, we are going to simplify things for you so that even a child can understand what are the learnings or takeaways that you can have from the collapse of the Silicon Valley Bank. So first things first, let's remove this confusion about this term. This term that I'm talking about is actually an acronym for three things, which I will be covering in this episode. So the first alphabet in term, which is T, stands for the most fundamental of things which distinguishes us as human beings from the rest of the world. So the first principle is really about thinking from first principles, or the fundamental way in which humans think that distinguishes themselves and makes them superior in a way, at least as we think, from the animal kingdom. So you might be wondering, what has this distinction between the human species and the animal species got to do with the collapse of the Silicon Valley Bank? Isn't that too much of a stretch? Well, not really, if you look at it and if you actually think of it from first principles. The manner in which I explained what really happened in the collapse of the Silicon Valley Bank was widely circulated and appreciated by a whole host of people. In particular, a lot of people came back with the comments that this is something that even non-finance people can understand, even marketing folks can understand, even a child of 5 years can understand, and that follows the principle of ELI 5, explain like I am 5. One of the side effects of oversimplifying this explanation of what happened and what led to this collapse is that people are now thinking that if it was so simple, it was so obvious, then why didn't those guys spot it themselves? Why did nobody in the system spot it? And why did things come to this? After all, in this ecosystem of Silicon Valley Bank, it was not just the bankers and the management and the board themselves who were experts in the financial services industry. The account holders were largely people who were venture capital firms, limited partners, people who were investing money and were doing this as a full time business, apart from startups who had raised huge amounts of capital and knew the ins and outs of financing, of venture capital funding, of running and building large organizations. So, if all of this collective group of people was not able to spot it, prevent it, detect it, and do something about it, then it begs the question, what were they thinking? The answer to that, I don't know, because I don't want to second guess what everybody was thinking. But one thing is very clear, very apparent. They were certainly not thinking from first principles or thinking fundamentally about what is it that they were doing wrong. If you're intrigued by this whole concept of thinking about thinking, and if you want to go deeper, I would strongly recommend one of my favorite books by a Nobel laureate, Daniel Kahneman, whose famous book is called Thinking, Fast and Slow. And he talks about a phenomena which we see increasingly more prevalent in the world. And even in this case of the Silicon Valley Bank's collapse, I think people at the helm of affairs have been guilty of fast thinking and not of slow thinking. If you read the book, you will understand. But if you are afraid of reading books which are 400-500 pages in length and particularly written by huge intellectuals like Daniel Kahneman, then I've made it simple for you. There is a short video which explains the crux of what thinking fast and slow is all about. But since you're already here, I will try and again make the explanation as simple as possible so that you can grasp it. Essentially, what Daniel Kahneman is saying, and this has been supported by a lot of neuroscientists, is that the brain has two parts to it. One part is the part which is responsible for automated reflexes, for quick reflexes, for things which we can do or perform without even thinking consciously. These are things which are deep seated into our subconscious thinking or our subconscious brains. Most of our lives, we go around living based on our fast thinking patterns, right? And this is an important element of thinking because without this, we would not be able to live our lives. For example, if you had to chew food, you do not have to think consciously that I need to move my lower jaw, my upper jaw is not moving, and despite the upper jaw being stationary, my lower jaw has to move and it has to chew food. So, if at this stage your attention is drawn to the fact that the upper jaw actually does not move, and you probably did not know this, or you never thought about the anatomy of the face and the fact that it's just the lower jaw which is moving, then what you're getting into is slow thinking. And slow thinking, by its very essence, is conscious thinking, where you are taking a pause, you are taking a step back, you are processing information very consciously. And at this point in time, your attention may not be directed to too many other things which are going on. In the hustle and bustle of life, particularly with the information explosion, with social media, with digital information overload, with overpacked schedules, with the hustle culture that is particularly prevalent in the startup ecosystem, we have a tendency to just go for fast thinking and not go for slow thinking at all. And we seem to be okay with it because everybody around us seems to be doing just that. And this question of everybody doing something brings me to the second point, which is the second alphabet in term, which is E for everyone. And that is a characteristic of fast thinking. Everybody seems to be doing it, so it must be right. And one of the biggest examples of this phenomena is what we've seen in the startup ecosystem itself. Now let's take a step back and talk a little bit more about the Silicon Valley Bank itself. As you already know, it was one of the most prominent players in the entire startup ecosystem and funding ecosystem, and by far the biggest bank to have an exclusive or sole focus on this sector which is the tech or the startup ecosystem. And the kind of people who become successful in this startup ecosystem by building unicorns seem to have endorsed a particular view. And this view is about growth at any cost, the exclusive and sole focus on valuations without looking so much at cash flows, at profitability, because these are for old fashioned guys who work in the old economy. Real business models, business metrics such as profitability, cash flows, they are not applicable to us because, hey, we are innovators and we are the startups. This whole concept can be applicable in a very small space when you are doing something disruptive, truly disruptive, when you are doing research and development and creating a world class product or creating a product which has the potential to change the way the world works for the better, to serve and meet some customer needs that is not being met by any other industry. But what really happened after that, from the small confines of these select tech innovators or disruptors that were truly working on changing the world and bringing to life such solutions, we saw a wave of people who just caught on to this model without really catching on to the ethos of what these companies, what the startup ecosystem, what the tech ecosystem, what the disruptors, what the innovators were doing. They just simply copied the same business model without really copying the innovation. For instance, these online grocery companies, these online e-commerce companies, D2C companies, they are throwing money at luring the customers into buying their products, downloading their apps, and in doing so, they are suffering negative unit economics. They have absolutely no clue even about their pathway to profitability, and they say they will figure about it later. And why does it seem to be justified? It seems to be justified because, hey, everyone in the ecosystem is doing just that. When you start living in a bubble and you do not even know that you are inside a bubble, guess what happens when the bubble bursts? You are caught unaware, and not only you, everybody in that bubble is caught unaware. And this is a big thing because everybody follows everybody and nobody knows what everybody is doing. If you've gone too far down that path and your thinking is set along the lines of how startups are running their organizations, how they are conducting their business, then I would recommend you watch this video where I've explained 23 startup jargons. And it's not just these jargons or these terms that I've explained in this video, but I've gone down to a fundamental level of how you should be thinking about each one of these terms and how you should be thinking about how to drive business, how to grow business through digital marketing or other means. So that was the second term of the three principal terms that I am covering in this video, that of everyone doing it. But what happens in the entire system if everybody is doing something which is inappropriate just because everybody else is doing it? It leads to a systemic buildup of risk. And this brings me to the third term, which is RM. And RM stands for, well, usually it stands for Rajiv Maheshwari when I write RM, but in this case, it stands for risk management. And this is a question which everybody, at least everybody who's doing some amount of thinking in the slow mode, is asking. How come the risk management people, how come the CEO, the board, the regulators, the Federal Reserve, nobody spotted these risks while they were building up? And why is it that they are only waking up at this last minute after all the crisis has happened, after all the damage has been done? And just as I pointed you out to my favorite author on the thinking side, my favorite author when it comes to risk management is Nicholas Nassim Taleb, who's written a very famous book on risk called Black Swan. And if you were to ask him whether the pandemic, the corona, was a black swan event, or whether this event, which is the second largest banking collapse in the history, which is the collapse of Silicon Valley Bank, if this was a black swan event or not, I'm sure without even battling an eyelid, he would have told you that this is certainly not a black swan event because this is something which was obvious, which was building up, which somebody should have seen. In particular, risk management is not just about managing risks, which are incremental risks, about 5%, 10% increase or decrease in profitability, etc. The function or the faculty of risk management is fundamentally about looking at risks which are much bigger, which are disruptive, which have the potential to threaten your very existence. These could be risks that can lead to an existential crisis. To give you an example from a banking standpoint, there is certainly a risk of a lot of customers or depositors asking for their money back at the same time. And in that case, even the most robust of banks will have a problem that will be very difficult to surmount. The probability of such incidents happening is very low, but these probabilities increase exponentially when you are far too concentrated in a particular ecosystem. And this is exactly what happened to Silicon Valley Bank. They were way too closely knitted in the entire startup or the tech ecosystem. And not only that, the different stakeholders or the segments of this industry were their customers. Whether it was the venture capital firms, whether it was the angel investors, whether it was the limited partners who are other investors into the VC funds themselves, or whether it was the startup companies. They all formed a very cohesive and cogent ecosystem of people who would regularly interact with each other. And they had a network effect because the larger VC companies would have hundreds of companies in their portfolio. They would be speaking to hundreds of limited partners who, in turn, would be in touch with many different venture capital firms and startup founders themselves. So, what happened in this case was that one behavior of somebody withdrawing their money and panicking or harboring doubts that their money may not be safe with Silicon Valley Bank led to a snowball effect. It led to a cascading effect. And I've heard a lot of people saying that while publicly they asked people to maintain calm, what did they do privately? They asked all their portfolio companies, they asked all the people who were connected within their network to immediately start withdrawing money from Silicon Valley Bank. And that is what led to this sudden collapse. And it is not just the Silicon Valley Bank model which is at risk because of these factors. If we look at the structure of the world today, we live in a connected world where information flows almost instantaneously to the entire world. And this can have huge implications in terms of the risk that is contained within the existing system. Let me give you an example which illustrates this risk that I'm trying to draw your attention to. I am talking about a huge pharmaceutical company called Eli Lilly. One of the mainstays of its revenues and profitability is insulin. Last year, somebody created a fake Twitter handle which looked suspiciously similar to Eli Lilly's official handle. And they tweeted that they are making insulin free. A lot of people panicked because they thought it was Eli Lilly, the official company, which was tweeting that it is making insulin free. And guess what they did? They did not switch on their slow thinking mode. They did not bother to check the veracity of the facts, the veracity of the handle, which could have been done in 2 seconds flat. It did not take too much time for anybody to figure out between the real and the official Eli Lilly handle versus a fake one, which has just cropped up. This led to panic and a chain reaction, maybe lots of WhatsApp forwards, and coming from authentic sources. Just because everybody seems to be believing it, people also believed in it, and the stock tanked in the matter of minutes. Of course, people realized eventually, and clarifications came out, and things were salvaged. But in that intervening time, disaster did happen. And for what? For absolutely nothing. For a simple prank. So if you put the three terms together, firstly, that of thinking consciously, deliberately, slowly, processing all the information, and thinking from first principles, to the second term of not doing something just because everybody seems to be doing it, but to go by the first term, which is your thinking. And third, and most importantly, to think about risk from a bigger perspective, to look at how the world has changed around us, how structures have changed, how things are not the same as they used to be, and consequently, it leads to a very different risk model that we are living in. As we rise higher and higher in the corporate ladder or do bigger and bigger things in our lives, it's extremely important to understand and appreciate and act upon the signals that are given by these risk management systems. I've worked at leadership positions for many years now, and I've been the CEO for over a decade. And in this period, what I learned is that it is extremely important to put risk management at the top of your pecking order when it comes to your priorities, when it comes to distribution of your time and your attention and your focus on what is it that you really need to focus on. Consequently, when I created my time management framework called Directed, I put disruptions and innovations right at the top of the pecking order of time management. And I strongly believe that while focus on the transactional elements on the day to day activities can get you short term success, but in order to move up the value chain, in order to build and sustain organizations for a long time, in order to build something that stands the test of time, you really need to be strategic about how you look at risks, how you perceive them, how you analyze them, and most importantly, what kind of structures are you putting in place to manage these risks systematically. This, unfortunately, is not a learning which most people are talking about when it comes to the collapse of the Silicon Valley Bank. In effect, Fed's BTFP, or the Bank Term Funding Program, has already assured that depositors will now not be losing their money. And this applies both to insured as well as uninsured depositors. So, my question to you is this: if we are talking about the United States, a lot of people now know that deposits of up to $250,000 are insured, and beyond that, the sum is not insured. My question to you is this: what about countries other than the United States? If you are living or working in any of these other countries, for example, in India, do you know the amount of deposits that are insured? Do you know whether this insurance amount is applicable to an individual across all the types of bank accounts that they are maintaining, or is it applicable only to one particular type of bank account or one type of entity that they may be associated with? What happens if you have a bank account in your name, in a joint name, in your capacity as a partner? And what happens if you're holding multiple accounts with different branches of the same bank? Let me know in the comments if you know the answer to these questions, or if you even thought about this risk applying to yourself as a bank account holder in the bank of your country. We don't need to be paranoid about the way we live and work, but we certainly need to be aware. These things do not need to take up all our time. In all honesty, thinking about some of these simple things and taking required action does not take too much time in the larger context of things. The issue really is that we are not thinking on the right terms. In fact, if we look at the terms, then we are not even thinking. We are aping what everybody is doing, and we are hardly thinking about risk management, going about the daily activities of our lives in a very transactional and trivial and automatic manner. So, as promised in the previous video on the collapse of the Silicon Valley Bank, I hope I've been able to give you some perspective which is slightly different and certainly useful from your perspective on what are some of the learnings and insights that you can draw from this episode. So, if you learned something from this video, ensure that you like the video and drop in your comments about what you found insightful. And if you want to continue receiving these insights, then make sure you subscribe to this channel and hit the bell icon so that you are notified. Otherwise, you know what is going to happen. In this algorithmic world, your feed will not be controlled by what you think or what you think you need to see. The feed will be controlled by the YouTube algorithms, which in turn will be driven by what everyone else wants to see. And that, my friend, is going to be a risk that you need to manage. And that, in a nutshell, was the crux of the terms that I explained in this video. So thank you very much and see you in the next video or in the previous video if you're going back to see all that you need to know about the collapse of the Silicon Valley Bank.